Markets move because money moves, and money moves for a reason. Follow the money. For thousands of years, one asset survived through wars, through empires, and through the rise and fall of financial systems. Gold. Kings collected it. Empires fought for it. Banks stored it. And civilizations trusted it. Gold was more than a precious metal. It represented something deeper, a form of value that existed beyond governments and beyond borders. But the modern financial world changed everything. Currencies became digital. Banks became global. And the US dollar became the foundation of international finance. For decades, countries around the world accumulated dollars instead of gold. US Treasury securities became the preferred reserve asset. They provided liquidity. They generated income. And they were supported by the world's largest economy. For many central banks, the decision seemed obvious. Why hold an asset that produces no interest when you can hold government bonds that pay a return? Gold appeared to belong to the past, a symbol of an older financial world. But history does not always move in one direction. Because recently, something unexpected started happening. The world's most powerful financial institutions began buying gold again. Not investors, not collectors, not short-term traders. Central banks. The same institutions responsible for protecting national wealth were quietly increasing their gold reserves. And this created a surprising question. Why would the organizations that manage the modern financial system return to one of the oldest assets in human history? Are they preparing for the decline of the dollar? Are they losing confidence in government debt? Or is something more complicated happening inside the global financial system? To understand why gold is returning, we first need to understand why the world moved away from it. Gold did not disappear. The world simply found a new way to store trust. The recent return of gold did not begin with ordinary investors. It began with central banks. The institutions that usually move the slowest. Central banks do not chase trends. They do not buy assets because of short-term excitement. Their decisions are usually based on decades of risk management. So when central banks around the world started increasing their gold reserves, people began asking one important question. What changed? For many years, the main goal of reserve management was simple: preserve value, maintain liquidity, earn a return. US dollars and government bonds were designed to achieve those goals. They were liquid, widely accepted, and connected to the world's largest financial markets. But the meaning of financial safety has started to change. In the past, safety was mostly about financial performance. How quickly could an asset be converted into money? How stable was its value? Today, another question has become important. Who controls the asset? Because reserves are not only financial tools, they are also national security tools. A country holds reserves because it wants the ability to respond during uncertain times. And uncertainty has increased. Economic conflicts, geopolitical tensions, changing relationships between major economies. All of these factors have changed how governments think about risk. This is where gold becomes different. Gold does not depend on another country's promise. It is not issued by a government. It does not require a banking system to maintain its value. This does not mean gold is a perfect asset. It produces no interest. It can be expensive to store, and it cannot replace the size and efficiency of global bond markets. But gold provides something different: independence. It acts as a form of financial insurance. When confidence increases, countries may prefer yield-producing assets. But when uncertainty increases, insurance becomes more valuable. This is why central bank gold buying is not simply a bet on higher gold prices. It represents a deeper change in how governments think about reserves. They're not abandoning the existing system. They are preparing for a world where flexibility matters more than ever. And one event made this question impossible to ignore. For decades, countries believed their foreign reserves were among the safest assets in the world. A reserve asset was expected to be liquid, reliable, and accessible when needed. But in recent years, one event changed the way many governments think about risk. The Russia moment. After Russia's invasion of Ukraine, many countries introduced economic sanctions. Among those measures were restrictions on Russia's foreign reserves. The event created a new discussion inside financial institutions around the world. The question was not whether every country would face the same situation. The question was whether reserve assets carried risks that were previously underestimated. For decades, financial risk was the main concern. Would an asset lose value? Would a market become unstable? Could an investment be converted into cash? But after this event, another type of risk received more attention: geopolitical risk. A country could hold large amounts of foreign assets. Those assets could be high quality, highly liquid, and widely accepted. But governments began asking another question: What happens if access becomes restricted? This changed the conversation around gold. Because gold has a unique characteristic. It is not another country's liability. A treasury bond is a promise from a government. A currency depends on the financial system behind it. Gold does not require a promise from another country. It exists as a physical asset. This does not mean gold is replacing the dollar. It is not. The dollar remains the center of global finance. But some governments began thinking about reserves in a different way. The goal was no longer only maximum efficiency. It was also maximum resilience. And this is why gold became attractive again. Not because the modern financial system disappeared, but because every system has vulnerabilities. For central banks, gold became a reminder that diversification still matters. The question was no longer whether gold could compete with the dollar. The question became how much protection gold could provide inside a world built around the dollar. China represents one of the most interesting examples of this changing approach to reserve management. For decades, China accumulated one of the largest foreign exchange reserves in the world. Those reserves were built through a powerful economic model. Manufacturing, exports, and global trade. As Chinese companies sold products around the world, dollars flowed back into China. Those dollars needed to be stored somewhere. For many years, U.S. Treasury securities played a major role in that strategy. But reserve management is never permanent. Countries constantly evaluate how to balance security, liquidity, and independence. This is where gold became increasingly important. China has gradually increased its official gold holdings over time. But the story is not simply China sells bonds and buys gold. The reality is more complicated. A country managing trillions of dollars cannot rely on only one asset. Different assets serve different purposes. Government bonds provide liquidity. Currencies support international trade. Gold provides diversification. The goal is not to replace one system with another. The goal is to create more flexibility. And China is not alone. Across emerging markets, many central banks have increased their interest in gold. Countries such as India, Turkey, and others have also expanded their gold reserves in recent years. The reasons are different for every country, but the common idea is similar. National wealth should not depend on only one option. This does not mean these countries are abandoning the dollar. the dollar remains the most important reserve currency in the world. But the role of gold has changed. It is no longer viewed only as an old-fashioned asset. It has become a strategic reserve tool, a form of protection against uncertainty. And this shift reveals something important. Countries are not necessarily leaving the existing financial system. They are preparing for a world where more than one type of security may matter. But this creates a bigger question. If central banks are buying more gold, does that mean gold could eventually replace the dollar? As central banks increase their gold holdings, one question appears again and again. Could gold replace the dollar? The short answer is no. But the longer answer reveals something more interesting about the future of global finance. Gold has unique advantages. It has existed for thousands of years. It does not depend on the promise of a government, and it cannot be created through a policy decision. But a global financial system requires more than a store of value. It requires a payment network, deep financial markets, and assets that can move quickly around the world. This is where the dollar system remains extremely powerful. The US dollar is used in international trade. It is the primary currency for many global transactions. And US Treasury securities remain one of the largest and most liquid financial markets in the world. Gold cannot replace that entire system. It cannot easily finance global trade. It does not provide a worldwide payment infrastructure. And it does not generate regular income like government bonds. So why are central banks still buying it? Because the purpose of gold has changed. Gold is not being viewed as a replacement for the dollar. It is being viewed as protection inside a system still dominated by the dollar. Think about it this way. A country can believe the dollar system will remain important while also believing that diversification is necessary. These ideas are not opposites. They can exist at the same time. The future of money may not be one asset replacing another. It may be a more complex system where different assets serve different roles. The dollar provides liquidity. Bonds provide income. Gold provides independence. And together, they create a more diversified financial structure. The real change is not that countries have stopped trusting the dollar. The change is that countries are thinking more carefully about concentration risk. Because throughout history, financial systems have always evolved when the world changes. And now, another question remains. If gold is not replacing the dollar, what does the future of global money actually look like? The return of gold is not a prediction that the dollar will disappear. It is something more subtle. It shows how countries are changing the way they manage risk. For decades, the global financial system was built around one dominant idea. The dollar was enough. The dollar connected global trade. It supported international investment. And it provided the foundation for modern finance. That system did not disappear. But the world has become more complex. Economic competition, geopolitical uncertainty, changing trade relationships. All of these factors have encouraged countries to rethink how they store national wealth. The question is no longer only which asset creates the highest return. The question has become which combination creates the most resilience. This is why the future of money may not belong to one single asset. It may belong to a more balanced system. The dollar provides global liquidity. Government bonds provide income and stability. Gold provides independence and insurance. And emerging technologies, including digital assets, may create new ways to transfer and store value. The next financial system may not replace everything that came before. It may combine different forms of trust. Because money has never been only about numbers. It has always been about confidence. Confidence that an asset will maintain value. Confidence that markets will remain open. Confidence that institutions will continue to function. Gold is returning, not because the world forgot the modern financial system. Gold is returning because the world remembers why trust has always mattered. Throughout history, money has moved from one form to another. From gold to currencies. From currencies to digital systems. And every transition was driven by one thing: changing confidence. Because in global finance, money rarely disappears. It moves. Follow the money.